Ladies and gentlemen of the crypto space, we're live on a Friday, July 8th at 11:39 a.m. Now, I got a nice topic that I wanted to talk about because of a post that I saw on Twitter from someone who I follow. I followed for a long time. And it's a meaningful story he tells about what he's done, why he's done it. Meaningful story he tells about what he's done, why he's done it. And guess what? It has nothing to do with crypto, or at least not predominantly to do with crypto. It's definitely not my mindset, but I would say his mindset is much more consistent with maybe a little bit older than me, or an older generation, or an older mindset, or an older narrative, or a different narrative, but a more traditional narrative, but a very comparable narrative to what we talk about and how we attack the markets and what I talk to you guys about, or at least how I attack the market. So I want to talk about that. I'll just pull up his Twitter page and his most recent tweet, and you guys will be like, oh, okay. That makes sense what Noah's talking about. No need to decipher Noah's tweets today. We could see it in visual form live on stream, baby boys and girls. All right. I want to talk about a comment, though, because Dan hit us right off the bat because he's at the beach, and we got to talk about a hot topic that's on his mind. Can you please break down value prop of bribes for V curve and VLCVX? This is probably one of the more important topics because of tweets that I just put out about deterministic smart contracts being immutable. They can't be changed. So no matter what regulating authority wants to enforce action, they would literally need to buy assets to attempt to affect the protocol. So, what are some of the few protocols in the entire crypto space that are the most meaningful? It's the ones that are not they're censorship resistant. Especially ones that have IPS deployed front ends, and we saw. Look what happened with Andre's original bribe implementation, user interface wise. There was After he said he was discontinuing it, a bunch of other people launched it. There was like 3 different deployments at one point. So the same thing could be done with the entire Curve Finance front end, the entire Uniswap Finance front end, and frankly, anything that has contracts, because you could write a front end to interact with the contracts. You don't even need a user interface to interact with the contracts. You don't even need uh, you don't even need a user interface to interact with the contracts. You could use local software. So it's very meaningful, the protocols that we talk about, because these are the ones that will survive even enforcement action. Anyway, so that's why we talk about a good part of why we talk about curve so much. So V curve versus VLCVX. So obviously, protocols are paying VLCVX more, about twice as much right now, for votes as compared to VECRV, which leads to an arbitrage opportunity if the voting incentive market was efficient, which is what Paladin was talking about the other day. My opinion is that Curve will become scarce in the coming years, uh, and not scarce in that people are going to buy it, retail participants. It's going to be predominantly controlled by protocols. They're just buying, mandated buying. The Federation, they're putting it in reserves, and that's the metaphor we've talked about as compared to sovereign nations. And they will just dominate. I mean, look, Convex already owns 54% of all available, Curve, VUCRV. They have that kind of voting strength, which entails there will be few or little or scarce retail actors, or persons that are capable of being incentivized to vote in a particular direction. Um, so I think that's meaningful because that's in addition to stuff like SDCRV and CVX, Voltlock CVX, and the other federated protocols that are accumulating curve, which you could incentivize at that level as well. It's just then what happens is arbitrage. As VLCVX becomes overpaid, it's more capital efficient for a protocol to pay the cheaper uh, for the cheaper CRV votes, which is like a VECRV or any of the other federated protocols. It's just something that's often overlooked. And another reason why I like it is because it's the base level implementation. Um, so there's dilution involved, but the revenue, the transaction fee revenue share, this is just a little tangent, is inversely proportional to dilution, but proportional to total transaction volume. So where do we expect total transaction volume to go in the coming years? Up. Where do we expect dilution to go? Also up. But I expect protocol transaction volume to go up significantly more than any potential dilution that would occur. And even if we're getting diluted at the VCRV level, we need to merely consider dilution with regard to retail ownership, not the protocols, because the protocols aren't taking incentives, bribes at like the Vodium VECRV level. That's also meaningful. Um, they're using their VCRV to vote at the respective federated level. Convex uses their VECRV vote for VLCVX voting, so that's a different bribe system. So that's something, or at least the way I like to think of these various levels or parts or components of the Federation. You'll see the arbitrage play out. And we see the arbitrage play out between literally just the CVX price point and the CRV price point. But as the market becomes more efficient, we'll see this arbitrage process play out with regard to incentives that are deployed for VCRV votes versus VLCVX votes. And that's my take on it. I hope that starts us off strong, Dan, and helps at least give some insight into the way I'm thinking about things. Killis, good morning. A pleasure. Zoidberg, Big Whale Crypto. How much CVX should I have to be profitable given Ethereum fees? That is a very subjective question, and it plays into the topic I want to talk about today. And so I'm going to start with the topic, and I'll circle back around to try and give you some insight to Big Whale. Crypto Bets, good morning. I made it. It's a pleasure. Rational thinking in an irrational market. Joe, still with the CRV. Oh, look, I should be talking about Bobcoin. Let's talk about Bobcoin and see if we can get a 10x return. Let's circle back around to the topic, and it'll help hopefully explain. This is hipster finance. Very different mentality, and if you want to see or hear the mentality that I was describing, scroll back to the start of the stream. He recently talked about dividend income from June. Taxable brokerage account was $1,200. Taxable brokerage account. He's talking about stocks. He's talking about traditional dividends. And this gentleman is not us. He did not, like ridiculously flourish in the crypto space in 16 and 17, 20 and 21. He's a dividend investor, which is kind of what we are from a crypto centric standpoint. But he thinks very much in terms of stocks, preferred stocks, whatever. Reads dividend bearing instruments in the equities land, and he has very humble origins from working, and he talks about in a lot of his posts the escalation of his portfolio over the years, the change of his mindset, and his portfolio has grown from reinvesting dividends and capital inflow from work. So it's very achievable to grow a dividend, a recurring revenue stream portfolio using less risky means. Sure, obviously we're in the crypto space and we can extend out on the risk curve to pursue capital gains, find 10x's, 100x's. That's few and far between. Very few people are ever successful at that. And this is not in the bullish of bullish conditions. Sure, you could get 10x's if you go out on the risk curve in a couple of days even. DeFi summer 2020, but that was irrational exuberance. That was absolutely irrational exuberance. So you were literally just taking money from market actors that have no experience. It was a completely irrational market. So I much appreciate what Hipster talks about because it is a very prudent and very humble way to get to where he's gotten to. And that's not a small dividend, hipster. He says, my dividend payments started off small, but now it feels like my money has a part-time job that I don't have to work for. Oh, these are some narratives that we talk about. I call that an employee. We have employees, where this is very consistent with the pizza shop analogy. So he's dabbled with crypto more recently over the last couple of years, or year or two in particular. He's mentioned various protocols, but it's not to the degree that we talk about. And it's not digesting these protocols for what they are and what they're capable of and the real impact that they're going to have on financial markets and society as a whole. And my perspective on these markets is from an engineering perspective, a quantitative perspective. What are they doing actually numerically, and what is the impact of them from a financial product perspective? And that's why, Joe, I talk about curve so much, because I just posted there's very few protocols that are very, very meaningful that cannot be influenced by even an act of Congress. Congress would literally need to buy curve and vote lock it in order to affect the voting process. You realize that? Well, how else do you can't affect the immutable smart contracts? You would need to have vote locked curve, VCRV. And not everything that's voted on at the curve level gets surfaced at a convex level. Convex is not voting on A parameters, they're not voting on everything. So the only way would be a raw base level VECRV position for the US Congress, or the SEC, or the CFTC, or whoever the hell eventually gets jurisdiction, or maybe it's the OCC, banking regulators. There's no way. There's no person to target. These are contracts, and they're immutable because that's the way the protocol was deployed. It's very much like Uniswap, or in some regards, to my understanding, good parts of Aave, not their institutional level product, but at least their traditional and historic product is currently hosted on IPFS. If you go to Aave's main website, it redirects you to an IPFS deploy. There's no way to force a person to change the protocol. That's the power of the smart contracts. And there's few protocols that are like that. I mean, look, how many times do you see an upgradable protocol or a protocol that says protocol paused? Those are enforceable protocols. Those are mutable. They're proxy contracts. They could upgrade them. That means the person who has those keys, or the multi-sig that has access to those keys, law enforcement could target them and force them to take action to change the protocol's behavior. It doesn't work like that with certain protocols if the protocols are designed correctly. And this is what Andre talked about. I mean, look, he talked about that a lot with regard to like Solidly. Now, aside from the complete failure of it from a monetary perspective, everything he talked about, he did. There was no way to change it. And it was so goddamn broken, there was no way to fix it. So, in that regard, that's meaningful. That's how contracts need to be deployed. They need to be so rigorously tested that you could deploy them without a possibility of changing them. Then they're not regulatable technologically. Technologically unregulatable. That's power. That's the promise of crypto. No matter what anyone says, the protocol is going to do what it's going to do. And that's why I love smart contracts so much. That's why I've talked about my experiences with equities and the most epic failure with Namaska Lithium and my distaste for boards. I want people out of the equation. I don't want to deal with a damn person. I want to deal with a contract that I know has specific deterministic behavior. It's going to do what it's going to do, no matter what anyone thinks, no matter what anyone wants, or no matter what any powerful regulating authority wants to try and have the protocol do. It's not possible. It will do what it's going to do. It's deterministic. That's crazy. That changes everything in my mind. Sir Joe's in the house. A pleasure. Crypto bets, some great questions already. I wanted to piggyback on CRV and CVX. For a new position, do you see CVX CRV or VLCVX as better? This goes into what Big Whale is thinking. Like, and these are very subjective questions, meaning you only know in hindsight. Maybe CVX appreciates more, and it's 4 month vote lock, so you could sell some of it and experience capital gains. CVX does control a dominance of voting rights, so that's meaningful. But if all of a sudden protocols are spending what 50 cents per vote, and then VE curve is 5 cents a vote, it's going to be much better to buy the VECRV in that instance, especially if more protocols, are throwing around voting incentives. So what's going to happen is it's going to change over time, crypto bets. Over time, there'll be arbitrage opportunities. It'll be more lucrative for a VLCVX vote as compared to a VECRV vote. It's a dynamic situation with trends and cycles because all this financial shit operates in cycles. And that's the deal. There is no optimal income generating position because what is the optimal income generating position will change over time. So there's a couple different narratives that play into that kind of calculation. Sure, you could have a position in both to be exposed to both, or how do I resolve that complexity? I want to own the base layer. I don't want to make as much money as possible. I'm not here to make as much money as possible. I'm here to do what most people don't. I'm here to see technology for what it is, not the bullshit that the general public sees that, oh, everything's crashing. No. What's the biggest narrative right now is that everything crashed, all of CeFi collapsed, and not a DeFi protocol, not the most meaningful DeFi protocols, had any issues whatsoever. Did you see Maker have any issues with liquidations? Did you see Aave have any issues with liquidations? No. I mean, even Abracadabra. Look at the peg right now. Might not be the most balanced stablecoin pool, but even Abracadabra is working as expected as a CDP. They did an appropriate tech implementation. Digression, it's not necessarily the best investment as we've seen from a price action standpoint, but from a tech standpoint, it worked flawlessly. Cheetah, wonderfully. That's very important because we experienced it recently with Bancor. Tech is imperative to understand. It's exciting, it's wonderful, and it makes all the difference with regard to figuring out where to deploy capital. But just great tech unto itself doesn't mean it's a good investment. So that makes it very difficult to deploy capital, which is why I go back to Joe, still with the CRV. I'm with the damn CRV because it has outperformed the shit out of the entire crypto space. It has done the best out of the entire crypto space. It is the most um, censorship resistant. It is so decentralized and so optimally deployed. It ticks all the boxes for me. And don't deploy capital based on what anyone says. You deploy capital only if you see it. Look, we talk about on Discord all the time convex, curve, convex, curve. Other protocols, Aura, Balancer, and there's plenty of other stuff. But what happens is, as folks play around on Discord and they go out on the risk curve, they end up coming back home. They end up coming back to the protocols that are the strongest, that are outperforming, and it's the core. It's really the core of the entire crypto space. It's the stuff that is working. And if it's depreciating less, it's working. Asun's in the house, a pleasure. Humberto, why have you decided to change from CVX CRV to VECRV? I haven't had a CVX CRV position in quite a while. But the logic there is very simple, is I don't want to own a derivative. I want to own the base layer. I want to own the protocol's transaction fees. And clearly, CVX-CRV surfaces the protocol's transaction fees, but one, it doesn't surface all the transaction fees, it surfaces the majority. And sure, it provides you the additional CRV as well as CVX incentives, but in 5-10 years, I expect those incentives to trend towards zero as there's excessive dilution. So those incentives are proportional to the price point of those each individual incentive respectively. But it's just going to get so damn diluted that they'll trend towards zero. And then the protocol transaction fees, the base layer fees, are proportional to the protocol transaction volume. So that should just increase over time, more and more and more and more. So there's my rationale there. Dark Forest, MEV. Soon, yeah, the owners of that are really like, um, was it Alchemist and Rook still, and but they have not proven to be good investments at all. Now Rook is a wonderful asset that we've talked about for years now, but it's performed horribly from a financial perspective, and it's just not on my radar from a financial investment perspective. But do I use it for limit orders? Yeah, oh hell yeah. Uh, this is something you should be using for limit orders. This is, in fact, I've used it for limit orders to buy my curve, and I got a 31 Rook bonus because they were able to capture that MEV from the Dark Forest, and it went into the Rook Treasury, and they give me the Rook as compensation, and that's the way this protocol works. Great protocol to use, great technology, horrible investment. Um, for limit orders. Limit orders, by the way, are completely underrated. So you got limit orders on 1 inch, limit orders on Maca. Um, so don't be afraid to use your limit orders because they're free. They're free Ethereum transaction fees. The market could have $500 Ethereum transactions, and you could do free trades using limit orders. So I think folks grossly underuse limit orders. So don't neglect the limit orders. Digression. Uh, Crypto bets. I know this isn't DeFi Dad, but could you do a quick walkthrough on how to vote lock Aura and how to vote on the bribes? Yeah, it's pretty simple, just very quick. You go here, and then you could go to so you could go to vote, and this is where you vote. And here's the gauge lock. I did that very quick. Let me do it again. You go to the main page. You go to vote on snapshot on the right. Here's your top one. It's the gauge, and you could vote. But what do you vote on? Now you got to go over to hidden hand and see where the incentives are. Actually, there's some decent incentives. That's pretty cool to see. Total voting power, 1 million. I happen to have 1% of the total voting power right now. That's pretty cool. A little less, 1.5 million. So it's like what, 0.75% of the vote. So that's how you vote. Now pick your vote. You got 3 days left, and that's how you vote. And then you'll get some incentives paid out on hidden hand. Hey, look, I got a couple of bucks there. That's nice. I mean, look, a minority position. This is probably about a month. A minority position in VoteLock Aura is meaningful as compared to good old hipsters' monthly revenue. So, but we're a bit out of the risk curve with regard to Aura. And you got to understand, this is relatively sophisticated. You're buying, if you're buying BAL Ethereum in an 80/20, you're vote locking that in a secondary derivative platform, and then you're voting on snapshot, but looking at bribes on hidden hands. So this is some very complicated stuff. It's very complicated and very overwhelming. To the fact that crypto bets, you didn't even see how to actually engage with the voting process. And scroll this back a couple of times if you need to, but that's how you do it. And it's not easy. Like I try to explain this to my wife sometimes, and it's quite overwhelming. But right now in this stream, you got a 20 to 30-second breakdown of how to do a relatively sophisticated process that completely overwhelms the general public. And that's very lucrative. So my hidden hand yields are from Balancer. So when I start to get that, that's going to be even more. So if we go over to the bribes page, uh, and we go to Aura, so I have about 10,000 in 3 days, I would capture over 50%. That'd be a $500, $700 claim, $800 claim, $800 claim, even more here. It'd be a majority. So that would be pretty big. And my Aura position was, holy crap, look at the price of Aura. All right. I took a very small position in Aura, and it was, obviously you guys could crucify me if I consider a $6,000 position relatively small, but it was about a 60, 65, $6,600 position. Holy crap, that's worth $2,300, $23,000. I'm quite surprised. I expected Aura to not appreciate as much as it has. I'm very happy with that position thus far. Oh wow, that's why it reached all-time high. This actually is a very good looking chart. Now, I could go back and say I should have bought more. I'm very happy with the quantity I bought because we have to remind ourselves to be humble and appreciative for even a little bit. And a little bit turns into a lot of bit over years. And that is exactly why I happen to really appreciate him. He's done very well. And that is something to be completely remarkably humble forgetting. Why? Because it's a part-time job that he doesn't have to work for. Money makes money. He has employees. He has a pizza shop. And he does it his way. He does it the way that he understands, the way his mind processes it. Therefore, it is sustainable and it is iterable. He could go to the next level. It grows over time. He doesn't have to go out on the risk curve figuring out an 80-20 BAL Ethereum pool deposit to get VE BAL, which gets locked in Aura, or what the hell vote locked Aura is some complicated shit. So that's why I like to talk about it, and that's why it's something that's proven very lucrative. Cheesecake, any opinions on CVX auto compounders? Badger, Pyrex. Badger is meaningful. I like Chris from Badger. He's wonderful. They've been very prudent, and I like how they've been very prudent to release Citadel. Badger's had a great run. They started in 2020, so I have a high opinion of Badger. Pyrex, Redacted, all right, fine. Some people like that stuff. I've never really been tempted by Redacted, but you could also go for the Union over on Llama. So the Union's interesting, and the Pounders. Convex. The Convex uses Pyrex, so there you go. Um, so this is tempting, and I appreciate what they do. You don't need to pay to claim, and it auto compounds, and you could withdraw depending on. There's probably limits for withdrawals depending on what's vote locked and whatnot. But so that's considerable. It's something. It's out of the risk curve compared to certain things. Um, you know, everything's out of the risk curve compared to dollars in this environment, but that's another story. So I understand your perspective for a smaller size portfolio, and this is definitely considerable. I'd probably opt for Badger just because of my subjective opinion. Um, I'm going to circle back around actually to what Big Whale talked about. He wanted to know what kind of size position, and I'm not going to give specific numbers because it's all subjective, but it just is what it is. It depends how much capital you have and how much money you want to generate, and also the risk involved, and also the structure of the portfolio. So it's not a simple answer, but it's relatively large numbers. You're talking if you get in 30% on your money and you put in 5 grand, you're making 1,500, $1,500 a year for 1650 a year. So if you want to make $1,000 a month, you're going to need You're going to need $50,000 capital allocation. At 36%, 40, 45, 4250, 42,500. So unfortunately, certain positions are out of reach, and I would argue that they should be out of reach because you need to respect the portfolio. If you've over allocated to a particular position and you don't have a diversified portfolio, you're taking excessive risk. And in this environment, what is a diversified portfolio? You need to have significant amount of cash. You need to be able to service your monthly bills. You need to make sure your debt obligations are under control. And now we're getting into standard money practice. standard financial advice, which manage your damn debt, and if you have excess capital, you deploy it. Money makes money. So standard stuff. Never invest when you can afford to lose, but if it's extra money that's making money, and it's not going to get lost because there's a high likelihood of survivability, which is what we focused on in this bear market. What survives is going to be the most meaningful. So that's the biggest thing to identify in this market. What has a greater than less chance of surviving? I hope that helps. It's not the most specific answer, big whale, but that's the deal. You got to think in terms of percentage returns. Now, these are returns you don't get in traditional finance that hipster has access to. 5, 6, 7, 10% returns, dividends on equities. But now we get back to the crypto space. One, it produces these greater returns because there's higher risk, there's higher complexity, and we do have to deal with survivability, but that exists also in the equity space. But just have enough cash, guys. Don't go and deploy and create an imbalanced portfolio, especially in this environment. A lot of things to talk about, and it's hard to craft a digestible story, which is why everyone tells me my stuff is a little all over the place sometimes. Last couple of questions. Dennis, GMX planning to introduce synthetic assets. Why haven't you made a position even though their revenues just continue to grow? Because I don't need to. I don't need to own everything that's great. And I have many friends and colleagues that have deployed the GMX, and that's great. And I think there's a great deal of survivability in the derivative space. But I focused on owning the base layer, and the base layer is a capacity to execute transactions and manage smart contract pegs. Which brings us back to exactly what Joe says, still with the CRV. Because I want to own the protocol that will facilitate profit from GMX actually being spendable. So if someone gets GMX returns or gets Avalanche returns or Ethereum returns using GMX, they're going to be going through Curve to turn it into a stablecoin to go to a debit card or to go to a bank account. That's the cash flow that I want access to, not necessarily the speculative or the return from speculative behavior in the derivatives market, the options market, which is what GMX services. But that does not diminish it as a meaningful component of the financial system. Look at all the derivatives and options that we've been talking about in traditional finance through the irrational exuberance over the last 2 years. Dominic, love getting out of work early and starting my weekend with the most rational person I know. Thank you. I try. We can do better, and we could be more rational. I appreciate all of you guys also. One curious view, a pleasure. Is it safe to connect wallet to Llama Air Force? Llama is quite reputable at this point. It's a small team. There's manual parts to the process. It's all about the risk curve. If you want to take that risk for simplification, that's okay. I mean, I can't tell a person to take a risk or not. Where's the llama? But they have a meaningful reputation so far. Very small TVLs, relatively speaking. So there's very few people exploring these positions. It's a subjective choice. But what is safe? Safe is safe until it's not safe. That's an unfortunate answer, but it's also true. So what's the safest of everything is just the base VECRV position. Then you're not less contracts, and this is the base layer contract, which is obviously what convex and all the other federated protocols are interacting with. They're all interacting with the base layer. So that's another reason why I opt for the base layer. I want to deal with less contracts. I want to deal with less complexity. And to even understand curve, I've heard people say you need to be mildly autistic to understand it. To even understand the base layer is extremely complicated. So I want to get rid of the additional layers of complexity, and I want to focus just on the base layer. So that's a good reason why I do what I do. Any thoughts on DAI and treasuries purchase? Yeah, I'm tempted for short-term treasuries, short duration, 1 year, 2 year. But I'm also skeptical, which is the historic conversation. We're um, digressing into treasuries. Uh, but that's a meaningful capital allocation potentially. Um, if there's a credit crisis and capital stops flowing, because that's what happened in September 2019, what do you think happens to bonds? Bonds go risk on. The burden there is, and the annoying thing for me is that it's a risk on play, meaning you have to sell at the top. I mean, if you look at March of 2020, well, it's still inverted. The twos and the tens are still inverted. But if you look at the 10 year, look what you had to do in March of 2020. Look at this wick. You had to sell. You had to sell. You had to buy it and sell it. A treasury, a bond, risk on capital gains. It's an awkward thing that folks are talking about, and I can't believe that 10 year right now is at 3.093. Holy shit! But that's basically what the bond market, or at least the market actors that love bonds, are discussing right about now. Is that if the system breaks and we have a deflationary event, bonds go straight down, yields go to zero. They're just going to go down, down, and down. But that's risk on. That means the bond price is going up, up, and up, and then you got to sell it at the top. You might as well be playing crypto and wait for them to juice the market, and then everything in crypto goes vertical. You sell that at the top. At least then you're working with on-chain asset ownership and working off a ledger device. This way, you have to log into a Fidelity site, find a counterparty to actually buy the stuff, put it in a transaction. It's a little different. It's actually quite different. Most different in the meaningful ways. That's why I come back to the crypto space after every conversation I have with myself to reflect on what we do in these markets and why we're doing it. It always circles back around to the crypto space for me. Yeah, Sam and Frax are interested. Obviously, Maker's doing some things with that Valley National Bank. It's very interesting. Um, I mean, we've had many conversations about stablecoins and what kind of collateral they use for backing. These are important conversations to have, and there's no reason to think that the sovereigns won't get involved. Meaning, the Treasury has a capacity to print bonds and issue debt, and they could sell that debt to Maker or Circle or Frax, and then Frax can mint a stablecoin. And then obviously, if the Treasury falls in value, they would have to liquidate it, and that's another story: how to manage the backing and how to manage the collateral. But the stablecoin is a form of a euro dollar. That's exactly what euro dollars are. Um, dollar denominated debt. Treasuries are dollar denominated. They're a collateral asset. If the liquidation price is hit, it's liquidated, and you get complex conversations like contagion and stuff. But it'd be very interesting to see in like the near future, 5 to 10 years, if Treasury adopts a eurodollar system in the form of a crypto protocol, and we see stable coins which are technically euro dollars in conceptually. That'd be very interesting. Much appreciated on the Oravo breakdown. You're welcome. Any chance we can pay with crypto to get access to Discord? I'd like that, and would love if LaunchPass actually supported it. I've been asking them for over a year. I will circle back around and do my best. There's been a large exodus of subscribers, and obviously I think that's unfortunate, not just for myself and the little bit of extra income it provides, but for people that want to keep up with the market and want to remain rational and want to actually pursue um, profitability or in the crypto space uh, in a sustainable way. Uh, you cannot engage with these markets by yourself. You need to engage with these markets bouncing ideas off of other people. And what's the most rational community to do that with? That's the deal. FM, you and your hex, my man. We'll end on the hex. We'll talk about hex. I like hex. I think it's a good experiment with regard to capital controls. But that's really all it is. It's an experiment in capital controls. Uh, what have we seen over the years with Doge? Doge has higher lows. It has massive volatility. Um, Horrible to buy at the top. Like you were absolutely destroyed if you bought Hex at the top. Completely destroyed. But if you bought Hex a year ago, you've done well. Or maybe more than a year ago at this point. I haven't looked at the chart in quite some time. Um, I mean, you got folks that have locked up for like what, 5, 10 years. So the capital controls are a strong force, which should produce higher lows over time. The problem isn't a problem for Hex. It's a problem with every asset. It's people that buy for the wrong reasons at the very wrong time. They buy at the top during periods of irrational exuberance. So these are very hard calculations. And probably the only thing I could say with things like Hex and Doge that are going to have higher lows unless we have a complete deflationary collapse of the entire risk system and everything. The only thing left standing is dollars. That's another story. Then everything is worthless except dollars. Um, is that they're outside of my interest. And it's imperative to not go all in and not spread too thin. And it's imperative to focus on things that you find the most interesting. Now, I don't find it the most interesting. I don't even find it remotely interesting. I find the notion of fees, transaction fees, and owning a part of banking rails, being able to capture a part of capital flow throughout the entire system as the most interesting thing. And the most important thing for folks to get over is that you're here to make the most money possible. That's the biggest thing to get over, guys. The second you try and make the most money possible, you're probably going to end up losing capital. Focus on the most meaningful things, which is income, and try and make it sustainable. That's the most important thing. A 10x capital gain, ooh, you got to buy something, you got to sell it at the right time. Ooh, 1,000% returns on the money. We see how well that played out. And all the inflation experimentation over the last 2 years. Horrible, devastating, destined to fail monetary policies. It's sustainable. It's the tortoise and the hare. Come on. Come on. I don't know. Do I need to go there? I don't need to go there. So I hope that helps. And it's a complicated conversation, Hex, because there's so much hyperbole and there's so much maximalism. You guys can't do maximalism. It burns you. It'll burn the Bitcoin maximalists or the people that think uh, the Bitcoin's a great investment because of what Michael Saylor says. Bitcoin's a great investment because of what Michael Saylor says. If you're Michael Saylor size and you have billions of dollars and you're making millions of dollars a year from a business in cash that pays your bills, he has a completely different calculation as compared to average Jane and Joe, making $35,000, $40,000 a year. And it's a completely different calculation dealing with emerging markets and other fiat, Sri Lanka and Argentina and places where and and Turkey and places where fiat currencies are collapsing and hyperinflating. Do you buy Bitcoin or do you buy dollars? This year in 2022, the buy would have been dollars because Bitcoin has significantly depreciated. Bitcoin is still cyclical. It's volatile. It's not the best thing to purchase under a variety of circumstances. The dollar would have been a better capital allocation. Another massively important thing to get over is our hatred of dollars. It serves its purpose at opportune times. I mean, guys, you got to remember, gold in Weimar images. Oh, space. So gold in Weimar, Germany, the mark, which hyperinflated through the roof versus everything, it went to zero. There were cycles, cyclical periodic cycles, where people were, that's all they were buying. They were just buying the mark. Do you see this? They were buying the mark hand over fist. The deflation was ferocious. Even the mark had its place. This is something important. People think it just goes to zero. It doesn't work like that. If you want to be successful, you have to understand the markets, the nuances, the history. And that's why we talk about what we talk about on the channel. One curious view, last question. Sailor playing with free money is as close to risk-free as he can get. It's all free money for him. It's all, I mean, he's also playing with other people's money. He's playing with the corporate balance sheet. But why that's acceptable mostly is it's consensus, it's the board, and it's also the shareholders. And clearly, if the price of the stock tanks enough, it's going to influence the shareholders to behave differently. But a big reason, and the biggest reason I can't stand equities is because look at that relationship. The board is doing what they're doing, and the only way the shareholders can affect the board is if they sell enough that the board is like, oh shit, we have to do something different. Our share price is completely destroyed. I can't stand that. And that's why I have the curve and the convex and the Chi and the FXS positions I do, and even the Aura Finance. It's and fixed forex I still have. That's why I like the crypto space as much as I do, because I don't have to deal with that bullshit of how you could convince a board to do something. No, I vote. If you vote with an equity, you're not doing shit. It's worthless. Your vote is nothing compared to the big actors. Friday, July 8th, we're going to wrap it up. Thank you, everyone, for joining. Tell everyone to subscribe. 12:26 p.m. A little late for today, but it is what it is. I wish you all a wonderful day. And you know where the after party is, on Discord, for the most rational community in the entire crypto space. And this is the most important time to be rational. Don't neglect the damn dollars, boys and girls. Don't get hurt in the market. Keep your capital so you can pay your bills. I'll see you again on Monday. Have a good weekend. Peace.